Start by defining leverage. In the world of hedge funds, leverage refers to the use of borrowed money to amplify investment returns. Hedge funds often borrow capital from banks or other sources, allowing them to invest more than they actually have. This strategy can potentially increase profits, but it also raises the risk of losses. Leverage is a fundamental concept in finance, and understanding it is crucial for anyone interested in hedge funds. Throughout this video, we'll explore how leverage works, why hedge funds use it, and the advantages and disadvantages it brings to the table. Before diving deeper into leverage, let's briefly discuss what hedge funds are. Hedge funds are investment vehicles that pull money from investors and use a variety of strategies to generate returns. Unlike mutual funds, hedge funds have more flexibility in their investment choices and often employ complex tactics, including leverage. They are typically managed by experienced professionals and cater to wealthy individuals or institutions. Understanding the basics of hedge funds helps set the stage for why leverage is such a common tool in their arsenal. Leverage in hedge funds operates by borrowing capital to increase the size of investments. For example, if a hedge fund has $100 million and borrows another $100 million, it can invest $200 million in assets. This doubling of investment power can magnify gains if the assets perform well. However, if the investments lose value, losses are also amplified. The mechanics of leverage are straightforward, but the implications are significant. Hedge funds must carefully manage their leverage to avoid excessive risk. There are several ways hedge funds can use leverage. The most common methods include margin loans, repurchase agreements, and derivatives. Margin loans involve borrowing money to buy securities. Repurchase agreements allow funds to sell assets and agree to buy them back later, effectively borrowing against them. Derivatives, such as options and futures, can also provide leverage without direct borrowing. Each method has its own risks and rewards, and hedge funds choose based on their strategy and market conditions. Hedge funds use leverage primarily to enhance returns. By investing more capital than they have, they can potentially earn higher profits if their bets pay off. Leverage also allows funds to diversify their portfolios and take advantage of more opportunities. For many hedge funds, leverage is a way to stay competitive and deliver strong performance to their investors. However, the pursuit of higher returns comes with increased risk, which must be managed carefully. Main benefit of leverage is the potential for higher returns. If a hedge fund's investments perform well, leverage can multiply the profits. This can lead to impressive gains for investors and fund managers alike. Leverage also enables funds to access more markets and strategies, increasing their flexibility. For successful hedge funds, leverage is a powerful tool that can help them outperform competitors and attract more capital. While leverage can boost returns, it also increases risk. If investments go wrong, losses are magnified. This can lead to significant financial distress for hedge funds and their investors. In extreme cases, excessive leverage can cause a fund to collapse. Managing risk is essential when using leverage, and hedge funds must have robust strategies in place to protect themselves from adverse outcomes. There have been several notable cases where leverage played a key role in hedge fund success or failure. For instance, long-term capital management famously collapsed in 1998 due to excessive leverage and market volatility. On the other hand, some funds have used leverage successfully to generate outsized returns. These examples highlight the double-edged nature of leverage and underscore the importance of careful management. Regulators keep a close eye on hedge funds' use of leverage. Rules and guidelines are in place to limit excessive borrowing and protect investors. Regulatory bodies such as the SEC in the United States monitor hedge fund activity and require regular reporting. These measures help ensure that leverage is used responsibly and that risks are kept in check. Compliance is a critical part of hedge fund operation. Manage the risks of leverage. Hedge funds employ a variety of strategies. These include diversification, hedging, and setting strict limits on borrowing. Diversification spreads risk across different assets, while hedging uses financial instruments to offset potential losses. Setting borrowing limits ensures that leverage does not become excessive. Effective risk management is essential for hedge funds to survive and thrive. From an investor's point of view, leverage can be both attractive and concerning. The potential for higher returns is appealing, but the increased risk may be a deterrent. Investors must assess their risk tolerance and understand how leverage affects the fund's performance. Transparency and communication from hedge fund managers are key to building trust and confidence. Hedge fund managers play a crucial role in deciding how much leverage to use. Their expertise and judgment determine the fund's risk profile. Managers must balance the desire for higher returns with the need to protect investors. Their decisions are guided by market conditions, regulatory requirements, and the fund's overall strategy. The effectiveness of leverage depends heavily on market conditions. In a rising market, leverage can boost gains. In a downturn, it can exacerbate losses. Hedge funds must constantly monitor the market and adjust their leverage accordingly. Flexibility and responsiveness are key to managing leverage successfully. Leverage ratios are used to measure how much borrowed capital a hedge fund is using. Common ratios include debt to equity and assets to equity. These ratios help investors and regulators assess the fund's risk level. Monitoring leverage ratios is an important part of fund management and oversight. Hedge funds often conduct stress tests to evaluate how their portfolios would perform under adverse conditions. These tests simulate market shocks and assess the impact of leverage on potential losses. Stress testing helps funds identify vulnerabilities and make adjustments to reduce risk. Transparency is a challenge in the hedge fund industry. Some funds may not fully disclose their leverage levels or risk exposures. This lack of transparency can make it difficult for investors to assess the true risk. Regulators are working to improve disclosure requirements and ensure that investors have the information they need. Leverage can create liquidity issues for hedge funds. If a fund needs to repay borrowed money quickly, it may be forced to sell assets at unfavorable prices. Maintaining sufficient liquidity is essential to avoid financial distress. Hedge funds must balance leverage with liquidity management to ensure stability. When hedge funds borrow money or use derivatives, they face counterparty risk. This is the risk that the other party in the transaction may default. Managing counterparty risk is an important part of using leverage safely. Funds often work with reputable institutions and use collateral to reduce this risk. Leverage can impact performance fees for hedge fund managers. If leverage boosts returns, managers may earn higher fees. However, if losses are magnified, fees can decrease or even disappear. Performance fees are a key incentive for managers, and leverage plays a significant role in their calculation. Educating investors about leverage is crucial. Many investors may not fully understand the risks and rewards associated with leverage. Hedge funds and financial advisors should provide clear explanations and help investors make informed decisions. Education helps build confidence and supports responsible investing. Leverage practices vary around the world. Different countries have different regulations and market conditions. Some markets allow higher leverage while others impose strict limits. Understanding global differences is important for hedge funds operating internationally and for investors considering cross-border investments. Technology has transformed how hedge funds manage leverage. Advanced analytics, risk modeling, and automated trading systems help funds monitor and control leverage more effectively. Technology enables real-time decision-making and improves transparency. The use of technology is a growing trend in the hedge fund industry. The use of leverage raises ethical questions. Is it responsible to take on high levels of risk with other people's money? Hedge funds must consider the interests of their investors and act ethically. Responsible leverage use is part of building a sustainable and trustworthy industry. Many hedge funds set internal limits on leverage to control risk. These limits are based on the fund's strategy, market conditions, and regulatory requirements. Setting and enforcing leverage limits is a key part of risk management and helps prevent excessive risk-taking. Open communication with investors is essential when using leverage. Hedge funds should provide regular updates on leverage levels, risk exposures, and performance. Transparency builds trust and helps investors make informed decisions. Effective communication is a hallmark of successful hedge funds. Leverage is used differently depending on the hedge fund's strategy. For example, long-short equity funds may use leverage to amplify both long and short positions. Macro funds use leverage to bet on global economic trends. Each strategy has its own risk profile and leverage requirements. Hedge fund leverage can impact financial markets. Large funds with high leverage can influence asset prices and market volatility. Regulators monitor these effects to ensure market stability. Understanding the broader impact of leverage is important for both funds and investors. The history of hedge fund leverage offers valuable lessons. Successful funds manage leverage carefully, while failures often result from excessive risk-taking. Learning from past mistakes and successes helps funds refine their strategies and protect investors. Looking ahead, the use of leverage in hedge funds will continue to evolve. Advances in technology, changing regulations, and new investment strategies will shape the future. Hedge funds must stay adaptable and continue to manage leverage responsibly to succeed in a dynamic environment. Wrap up: leverage is a powerful but risky tool in hedge funds. It can amplify returns and provide flexibility, but it also increases the potential for losses. Successful hedge funds manage leverage carefully, communicate openly with investors, and stay compliant with regulations. Understanding the pros and cons of leverage is essential for anyone interested in hedge funds, whether as an investor or a manager.